Good day, everyone. Welcome to this month's live market update. My name is John Pasalis. Uh, for those of you, this is your kind of first one. If you're new to these updates, we like hosting these. I like hosting these once a month to kind of really give a good look at what is going on the ground in the housing market. I have Gus Papayoano and David McMahon from our team who are going to be unpacking some of the things we're seeing on the ground. David Larock, mortgage broker, writer at movesmartly.com as well, will be joining us as well to talk about the latest trends that he's seeing in the mortgage market. As always, if you have any personal questions, you can write them in the comments below. If you'd like to meet with me and my team, you can also click the first link in the show notes. So let's kick things off. We're going to unpack, as I said, we're going to look at some of the latest numbers for the housing market, houses and condos separately. I'm going to take a closer look at some numbers and trends in the condo market. It's the one segment of the market that we're kind of keeping a closer eye on right now because we see a ton of inventory. And we're going to chat a little bit of some on-the-ground trends we're seeing with Gus and Davin, and of course, the interest rate outlook. Last month's market update, I kind of touched on a piece I'm going to be working on whether Canada is propping up pre-construction condo investors. And that piece should be out sometime next week on Move Smartly on our YouTube channel and on our podcast. So keep an eye out for that. So we're going to just quickly look at some of the latest numbers in the housing market. We're going to look at houses, specifically detached homes. And detached home sales in the Toronto area for the month of May were just over 3,000. And outside of the lows that we saw during COVID in 2020, this is actually the lowest sales volume in nearly 25 years. I think the next sort of lowest was in 2000, actually. So over a 20-year low in new sales, in sales volume. So clearly a sluggish market. So when you hear people talking about the market is very slow, I mean, this is what we're talking about. This is what what we're seeing on the ground is relatively soft activity when it comes to sales for houses. When we look at the number of new listings for houses, they're above last year, but they're in line with kind of relatively historical norms. So nothing extraordinary when it comes to new listings. Active listings are above recent trends, but active listings, we got to take active listings with a grain of salt. Typically, when active listings are very low, it's one of two reasons: either because the market is booming the way it was in, say, 2021 and 2022, so demand exceeds supply, so active listings plummet. And last year, active listings were low just because new listings were at a 20-year low. But the volume right now that we're seeing in terms of active listings is not out of the ordinary. It's in line with historical norms. But what we're seeing on the ground, of course, is a market that is slowing down. It's something that I've been talking about on the show, on our monthly roundtable, on my updates. And we can see this by looking at the months of inventory, which is we look at the number of active listings right now divided by the number of sales. That tells us how long it would take the current inventory to sell, assuming the same level of sales over the next few months. And we can kind of see months of inventory has been trending up. We're about 2.5 months for low-rise houses. And prices are down year over year. And this is a trend I've been talking about. Prices basically peaked in May of last year. We had this bit of a rally last year because fixed rates fell, because listings were at a 20-year low, or new listings were at a 20-year low. So we're comparing to that mini peak last year. But month over month, the trend is, it's been up recently, but I'd say prices are plateauing, but we're still down a little bit compared to the last year. Now, when we look at the stats for condos, it's a slightly different narrative. Unlike low-rise houses and detached homes, sales are at an almost 25-year low. Condo sales are soft, just under 2,000 sales in the month of May. Which is low, but not a 25-year low. I mean, it's above, it's well below sort of recent trends, but we're above sort of 2020, 2022. And if we look back in time, the next lowest is probably in around 2006, 2007. So still soft, but not quite as soft as the volumes we've been seeing in low-rise houses. Now, when we look at listings, on the other hand, new listings for condos at a kind of all-time high for the month of May, just under 6,000 new listings hit the market. The previous highs were kind of closer to 5,000. And then when we look at active listings, over 8,000 condominium apartments, this is condo apartments available for sale, which is not just the highest level for the month of May. The previous peaks for the month of May were close to 7,000 back in 2015 and 2014. But this volume of active listings is actually the highest for any month in any year in the past. And I'll kind of show a chart in the coming slides that looks at that as well. Similarly, months of inventory is trending up for condominiums. I mean, since the start of the year, we're at 4 months of inventory. And again, when we see inventory pick up, months of inventory in particular, it's a sign that the market's cooling. So, when you hear realtors talking about the market rallying and things are going to get crazy because of the rate cuts, this is really what we need to look at, months of inventory, because it tells us the momentum in the market. I'm going to show you a more timely chart in a bit, and we'll see how things are evolving. Condo prices are also, down slightly year over year for the same reasons. We're comparing ourselves to the mini peak last year. But again, I'd say they're relatively stable recently. Now, when we look at the months of inventory on a weekly rolling average, this is kind of where we can see the momentum shifting. And I've talked about this on previous live updates, how we started to see the change in direction. And we can kind of see that in late March, early April, things turned. And now we're in this period where inventory levels are increasing. We were below 2 months of inventory for houses. End of March, we're above 3 months of inventory now if we just look at it a weekly rolling. And condominiums as well, we were kind of close to 3 months of inventory, and now we're pushing 5 months of inventory. So this is when the momentum kind of picks up. It's a sign that the market's slowing. Fewer, in the case of low-rise houses, fewer offer nights, fewer bidding wars, fewer homes selling on their offer nights. If a home does have multiple offers, they maybe have 2 or 3 offers rather than 10 offers. And this is a sign of a market that's starting to slow down. In the condo market, units are sitting on the market longer. It's interesting to note that, even with the level of inventory we have now, it's still less than what we had in the fall of last year. Fall of last year, we were kind of pushing very close to 6 months of inventory, which is, of course, a softer market. So we'll see how things play out in the months ahead. But the condo market is generally relatively sluggish now. So on that note, I thought I kind of pull some statistics specifically on the condo market, just to kind of look at some of the trends. Now, this shows the number of active listings since, over the past, since 2000, actually, for every month. And of course, we see some peaks and valleys for seasonal differences. Many of these peaks, interestingly enough, are around sort of this time of year, May, June, July. And we can kind of see right now, at over 8,000, we are at the highest level in any month in any given year. Now, of course, one thing we're going to have to keep an eye on is if this trend follows the seasonal patterns where active listings starts to decline in the fall. I don't think that's going to happen. I think they're going to stay relatively elevated. But again, I think this is a trend we're going to need to keep an eye on, because obviously it's going to impact sort of where the condo market goes in the future. Now, one question I got asked by a journalist, I was doing an interview with the Toronto Star, and she wants to know if it's just micro condos that are seeing this big increase in listings, because it's the idea the investors are unloading. So I looked at the data, and it is not just micro units. So, one way we can look at that, and the way I did look at that is I said, okay, well, let's look at the number of new listings that hit the market over the past 3 months this year, and compare that to the same period a year earlier. And we can kind of see how much new listings have increased. So I think the volume of new listings is up something like 33%. And then we look at, well, what is the growth by unit size? And if they're above 33%, well, that shows you a disproportionate increase in that segment. And if it's below, it's a below average increase. So when we look at the data, interestingly enough, the two segments that are sort of below the average growth are actually the smallest units. So those units that are under 500 square feet and units that are over 1,000 square feet. The biggest increase is in units that are 500 to 599. Those are up probably close to 55% year over year, followed by units that are in the 6 to 700 square foot range. But so we've seen kind of pretty broad increase. You know, even units in the 900 to 999 square feet are up above the average, you know, close to 40% increase. So it's really just those two segments, the really, really small units and the big ones that are not up quite as much. I mean, it's tough to explain why. Probably the really micro ones cash flow a little bit better, you know, and maybe they were just recently purchased. And then the bigger units are probably more likely owner occupied units, so are less likely to sell. Now, the other trend I wanted to look at was the change in the change in the number of active listings or new listings by occupancy type. And the three main occupancy types are owner occupied, tenanted, and vacant. And vacant, I should say, is typically a good proxy for units that were previously rented, because many investors try to list their units after their tenant has moved out, or they negotiate to have the tenant move out so they can sell it vacant. It's harder to sell a unit when it's tenanted. So vacant units are typically a good proxy for units that were investor owned and are now they're trying to unload them. And when we look at those numbers, the year over year change in new listings, we see an interesting dynamic. I mean, not surprising. So the year over year on average is up, say, 33% in terms of total new listings, but vacant units are up over 60%. And owner occupied units are up only 20%, tenanted units up close to 12%. So we're seeing the biggest increase in vacant units. And again, I think a lot of that is indicating that this is generally investors whose units went vacant rather than renting them out, partly because the rental market is so soft right now. Rents are actually declining. They've just decided to sell them and move on. So I think that's obviously an important indicator to kind of keep an eye on. That again, a lot of this increase is driven by investors unloading. But again, I think one thing to keep an eye on is why are so few tenanted properties, or why the relatively modest increase. And again, that goes to this idea that it's tougher to sell a tenanted property. So I ran some stats recently to look at that. And when we look at the number of active listings out of all the condos that are available for sale in the market, 1 in 4 of them are actually tenanted. So 25% of the active listings are tenanted. But when we actually look at the number of sales over the past month, only 1 in 10 or 10% of the sales were tenanted. And this is a, you know, kind of a good indicator to show us that the buyers are a little bit less interested in buying tenanted properties for a couple of reasons. Number one, if it is an investor who's buying, you know, if the rents are below market, they of course don't want a property with below market rents. They'd like to get, you know, current rents is one reason. But that's kind of, I think, less of a factor. We're seeing fewer investors buying today. End users who want to sort of occupy the unit are just concerned that the tenant isn't going to move out. Even if they give them the proper notice, the tenant might decide, you know what, I'm going to fight you in the landlord-tenant board. And, you know, this is becoming less of an issue today. It was more common during COVID that tenants would refuse to move out, but we still have this lagged fear that some buyers have that tenants are just not going to move out. And I think that's still impacting the market. And it's worth noting that almost never happened before COVID. I mean, before COVID, you know, a tenant got notice, they would always move out. You know, but since COVID, you know, tenants kind of really we're taking advantage, obviously, of the lockdowns and the delays at the land and tenant boards. So some of them were not moving out. And I think some buyers have this anxiety that that might happen. So they don't want necessarily to take over a tenanted unit if the tenant doesn't move out. So that's one important trend. Another important trend I think that's weighing on the condo market before I bring on kind of Gus and Davin, and this is just stats I looked at recently. If we look at the proportion of listings on the market that are condominiums, 45% of active listings in the Toronto area are condos. But when you look at what people are searching for on realtor.ca, and this is just based on stats actually that realtor.ca just sent us, they sent to the industry, only 18% of people in the Toronto area are looking for condos. So there is a slight disconnect between what people are searching for and what is available for sale. More people are looking for houses. And I think that, of course, is weighing on slightly on the slowdown that we're seeing and why the condo market is a little bit more sluggish. So, what does this all mean for buyers and sellers? Again, we're in a sluggish market. We're in a slower market. I think we need to be mindful if we're buyers, what we're paying for properties, especially if there's multiple offers. It's not a period to be overly aggressive. When we're working with sellers, we need to be far more mindful of what our pricing strategy is, because it's not a slam dunk. It's not like 3 months ago where you just list everything low and expect to get 10 offers. The market's quite different. And we need to be more mindful of that. So actually, on that note, I'll bring in Gus and Davin, and hopefully they can share some of their feedback and insights based on their own listings recently. Because I mean, we kind of chatted in our sales meeting every week, and they had some interesting, different perspectives depending on these, two different properties they were listing in their respective markets and taking different approaches. So thank you, Gus, Davin, joining us again this month.
For sure.
And Gus, Davin, actually, why don't you kind of kick things off? Maybe talk about your listing, where it was, and some of the things we're thinking about when deciding how to price the property. And before you do that, actually, I should say to everyone who's not familiar with pricing in Toronto, I mean, there's generally kind of one or two ways. You either price the property for what you want or what the seller wants and just wait for a buyer to bring an offer. That's kind of old school, traditional kind of pricing. In Toronto, a lot of people, sometimes when the market's very competitive, agents and sellers will price the property for less than what it's worth, set an offer date a week later, and with the expectation they're going to get 3, 4, 5, 8 buyers who bid on it and get a price above the asking price. So on that note, maybe if you can kind of unpack a couple of things that you were kind of keeping in mind, Davin, when you were thinking about your property and where it was and some of the dynamics you were seeing.
Yeah, sure. So through all these updates, we've always been pretty key on being, pretty hyper local in all our analysis and commentary and stuff like that. So, listing an individual home is going to be really no different. So where we were, I mean, we're in the east side. I don't know if people are familiar with East York, but we're in an area near Eastland Park. It's close to Monarch Park, lovely school, or Earl Hag School. All in all, a tip-top neighborhood. It's not a super plus premium, but it's certainly an A. I'll give you that much. So looking at the market before we listed, there was quite a few properties that would try to hold offer nights and just inevitably fail. Some were successful, and these are the ones that were just, kind of the cream of the crop, priced well, and obviously were marketed well. And so we were just unsure what exactly to do, only because what we thought the value was going to be not terribly far off $1 million. So what do you do with that? Here's the hard part. If you price it at what you want, let's just say, for example, it's $1.05 million. If you price it for what you want, you're cutting out the buyer pool is actually going to look at that property. Anyone looking $99.99 and below, see you later. No chance, not coming forward. If they don't have a down payment of 20%, they're already out. So we're just sort of towing the line of like, do we do that or do we underlist? And to me, it seemed a little more obvious. It wasn't for sure, but to underlist. So we did price it at $929. To drive a little more traffic, get the eyeballs, and ultimately get more offers to end up at, what we actually, gathered a great sale price. So it was a matter of, looking at the market previous and looking at the market, what was available inventory wise, right at listing, up to hours before actually listing, seeing what's actually out there. When are they having their offer nights, and how have homes performed the previous week. And we did get a good outcome. I think it was really important to get all the eyeballs again on the property to be successful, because I think if we listed at what we kind of wanted, it would have been just slow. It would have been slow, and we may just still be for sale now. I'm not really sure, but it did end up being a good listing and a good sale. My clients are happy, and now we got to go buy something.
And out of curiosity, what was your showing volume like, and number of offers on your offer night, just roughly?
That's actually a good, it reminds me of something that I wanted to talk about. So showings, we had, I want to say it was 21, not a ton, but not bad for this market. But what I did find, which don't do this, by the way, so many realtors are just sending their clients to the open house
Yeah.
with no communication, not booking a showing. If you have to do that, book a showing. So I know your clients are going, and so you can be updated with the information. I must have had, through the open house, I think ballpark, I think about 35 parties in total.
Mhm.
And I would say 32 of them were sent with, they have a realtor who they could name by name. And I'm like, I don't
Interesting.
even know who these people are because they haven't booked a showing. So I would guess, for real traffic, 50 parties, something to that.
Helpful. That's good. And then,
We did get 4 offers.
okay,
Um, and yeah, firm sale. So
that's
happy with that.
helpful. Awesome. Congrats. And Gus, maybe unpack what you were kind of going through and thinking, because your listing was kind of in a different area. Um, Maybe walk through that as well.
For sure, yeah. My listing's in Langstaff, Richmond Hill, so York region. It's the northern part of the GTA. Kind of similar. Uh, it wasn't. I believe yours was a semi, wasn't it, Davin, or
Yes, it's a
semi?
2-bed semi starter home, which
Yeah.
should do
Mine
well.
was a 3-bedroom town, which means it's connected on both sides, so it's like a row house, but a freehold, not a condo townhouse. And in terms of price, we're actually taking offers tonight, so I can't give up too much information on the overall details, other than saying we had to, and we do this for every single listing. Okay, how are we going to list? Some agents will just say list low because it works. Well, yes, but again, region to region, not necessarily. In this particular area, I took a look at the amount of showings homes had leading up to us listing. I also took a look at how many offers the last 4 or 5 received, the month before we were listed. And that data helped, because it basically, one had 6 offers, another one had 4 offers, another one had 4 offers, another one had 3 offers. So that tells us that, yes, those 4 sold, but there's easily another 4 or 5 buyers out there in that specific neighborhood, Langstaff, that are still looking and waiting for more listings to come out to offer on. That, based on and the fact that there wasn't a lot of good inventory available that looked really good. There was a couple other listings that were just not renovated, not presented well, not professional photos, not staged. So I was fairly confident we would pull a lot of the traffic. So we decided, we were pretty sure to price low was the better way to go, and that's what we did. Price $1,049,000. Again, I won't divulge what we're actually worth. We'll find out tonight as we're getting offers. In terms of traffic, we've had a very busy week, 45 or so showings, and I think 112 people came through the open house. So it
Wow.
was extremely busy. Feedback's been fantastic. And I really think it comes down to a couple things. Yes, we priced low, but B, we look great. We really do look nice compared to a lot of other listings, and we got a lot of that commentary. And it's a great home in a great neighborhood. So I do expect that we're going to get some offers tonight. I don't know how many yet, but happy to report back when
Well,
when
Gus, in our
actually.
meeting, you were saying you actually got a couple bully offers, right? Preemptives.
Well, we had a couple people that were interested in
Right.
offering bullies, which is interesting. On the weekend, got a couple calls and a couple people that were like, "Would you consider a bully offer?" And usually when that happens, especially right off the bat, when you're only listed a couple days in, then you've chosen you're 100% sure you've chosen the right strategy, because there's a lot of buyers in the neighborhood. They're waiting, and some of them might be. I mean, they shouldn't be, but they might be moving on FOMO, fear of missing out, and that's why they're like, hey, maybe if I give you a bully offer kind of thing. So yeah, busy market in Langstaff, Richmond Hill.
That's I mean, I think these are great stories because I think it really highlights these regional differences and differences for house types. I mean, Gus, effectively, I mean, you had roughly 3 times the showings, that Davin had. I mean, between showings and buyer visits at open houses. I mean, Gus is at Davin's at 50-ish, you're like 150, it seems like. And I think this is why, you know why for you it was kind of more of a slam dunk to list low. Davin had to think about it a little bit more. And I think these are the things that sometimes sellers don't realize, that these decisions are regional based on, obviously where the home is and the type of home. And the same strategy doesn't work everywhere, even at the same time when you guys basically listed the same week. So I think that's an important nuance. And similarly, if you're a buyer, if you're looking, I mean, you have to kind of understand the regional differences. Some segments in some areas are a little bit slower. And I think it's helpful to understand that because it impacts even your offer strategy when you're buying. So that was helpful. Anything else you guys are kind of seeing on the ground over the past kind of month or so that you thought might be kind of worth unpacking?
I have a, just comment. Basically, it's anecdotal, but I know summer's going to be sluggish and we're in a slowing market. I don't know why. I have a feeling it's just going to be a little busier this summer compared to the norm. If we're smoothing out how many listings there are, how many sales there are, let's say it drops to 30% in the summer. I don't think we're going to drop that far as like activity goes, just because we're well into June and there's people still listing homes that are attractive and people are still showing up. I mean, Gus's point is right there. So I don't think it's gonna be like a sluggish summer, as sluggish as it should be. It's going to be slow, but I just don't think we're going to be quite as slow. Everyone kind of putting their feet up, and it's just a feeling.
It doesn't. Yeah, and it doesn't feel as slow as last year. I mean, I feel like, I don't know if you guys agree, like second half of last year just felt like insanely slow, like slower than even now. But anyhow, yeah, it'll be.
I agree. I agree with Davin. And just to so viewers can understand, what we mean by this isn't that everybody's running out to buy a house,
No.
but there's a lot of people we're communicating with in the background. Yes, sales are slow, and they'll probably continue to be somewhat sluggish throughout the rest of the year until rates come down a few notches. But there's just a lot of people inquiring, a lot of people that are, let's say, getting themselves ready, so to speak. I was speaking to again a neighbor and a friend who works for TD, and they seem to activity has picked up again on applications and to get a mortgage. I'm sure Dave Larock can also speak to that too. And it just seems like there's activity, there's people inquiring, but there's not a lot of freeholds out there, but there is opportunity in the condo market. So we'll see. I don't think August will be your normal sleepy August. I agree.
Yeah, and I think one thing worth unpacking, maybe before we bring Urmi on to take questions, is that, I mean, the Toronto housing market's very interesting because we are, as I said earlier, pretty much at a 20+ year low for low rise / detached home sales. And the market's still kind of competitive. We talk about it being slow, meaning the volume's slow. It's not as busy as it normally is, but it's still competitive, and there's still multiple offers, and it's still only 2.5 months, even though inventory is picking up. 2.5 months of inventory is like a pretty competitive market. And this is why things can kind of swing pretty quickly depending on how listings go and demand goes. But yeah, it's fascinating that even with this kind of soft demand, we still have what is relatively a competitive market in low-rise homes, at least selling pretty quickly. Urmi, I don't know, maybe we'll bring you on. I don't know if we have any kind of questions to go over before we bring on David.
Hi, everyone. Yes, I think this is a good question because while it hangs on wondering where interest rates go, I think it illustrates that when you don't know where they're going, there's still some real estate market questions about. So, how do you handle it?
Mhm.
So here's a question. We got it from email from Green Horizons. Thank you. Hi, John. We have a 20-year tenanted condo in a prime location in Toronto. Bought it pre-construction 20 years ago and now interested in selling. Would it make sense to wait until there are a few more rate cuts, perhaps even into next year, before putting it on the market? It appears that there is a lot of condo product on the market right now. Want to ensure that we get the best price for it and can be patient waiting for the right time to sell. Any thoughts on this would be great.
Oh man.
Sell it.
Hmm?
20 years ago, why are you selling this thing?
I know. This is so hard because this is like the crystal ball question, right? Like, do we list now or do we wait? I mean, the reality is it's a tough time to sell. I mean, places are just sitting on the market, right? So even if you list now, you're gonna sit with it vacant for months until it sells, right? Um, Will condo prices dip over the next 6 months? I don't know. Like at the end of the day, it is a possibility. Like it's a risk. At the end of the day, inventory is accelerating. I know if it continues to pick up, as I said earlier, leading into the fall market, you might see some sellers just say, okay, you know what? I want to unload this. We'll slash the price. On the flip side, if inventory dips and sellers are stubborn and they just say, you know what, I'm holding on, I'm just going to rent it if I can't get the price I want, we're going to see some stability. And so again, it's so hard. I know, and I know, I'm probably going to get trolled from some of the bears who are convinced they know what's going to happen. We don't know what's going to happen because like predicting what's going to happen is a function of both interest rates, the sentiment of sellers, how much can they hold on. So it's a very hard question. I mean, at the end of the day, I think I personally wouldn't make the decision based on where the market's going. I mean, I think if you have a property and you want to do something else with the money, then you sell now. If you're not in a rush to do something else with the money, then just rent it and wait. But the challenge, and I'll say the challenge with renting is, and you have to think about this in terms of time horizon. I've talked about this with investors recently who are like, I'm just going to rent it. The challenge earlier in the segment, you kind of have to wait for the tenant to move out before you sell it because it's hard to sell a tenanted property, right? So as long as you're not in any rush to sell it, that's fine. You know what I mean? But so that's the only thing I would keep in mind if someone decides to just hold on and rent it, that selling it 12 months from now, if the tenant's still there, might be tricky because you might have to negotiate a deal to have them move out, which costs you money. They might decide not to move out, which makes it harder for you to sell, which will cost you money because you might get a little bit less than market value. So those are the considerations I would be thinking about. And again, obviously they're very personal, so I don't have a crystal
Yeah,
ball.
I have some. Sorry, I have something to add.
Yeah.
I mean, let's think about investors. How did they buy condos in the last 20 years? They're buying them off floor plans for cash flow, basically. So right now, there are some horrendous floor plans and views and exposures out there for condos,
Mhm.
right? So if this person has a condo that, has some marketability to it, it might be a little bit of a different product than like just the slew of stuff that's out there. Because I see Gus nodding. There is some terrible condo product on the market right now.
Mhm.
Terrible. Because they
Yeah.
bought it. They bought 455 square feet. They didn't care what it looked like. They just knew they could stick a tenant in there, collect some cash, and away you go. But now they got to sell them, and they're awful. Who wants those?
Yeah, I'll also add to, I mean, I've had this conversation recently with a couple investor clients who are thinking of selling. And the first question I ask is, are you cash flow positive? And number one. And number two, like what John said, what are you going to do with the money? Do you need it or do you not need it? Or is this just a timing thing? And, I suspect if this is a 20-year-old condo, I imagine they're cash flow positive. I imagine they have a ton of equity, right? So if you don't need the money and you don't have a purpose for it right away, I would wait. But again, you can't predict it 100%, but I would just 3 more years. Let's give it another more years, and I think I suspect we'll be healthier in 3 years than we are now. I know, again, some people might argue it could go down further, and it might, but in 3 or 4 years, it will be better. If you don't want to wait that long, then, like Davin said, if it's a really good layout, because it's a 20-year-old unit, it probably is a better layout. Maybe you have an advantage. If it's a corner suite, not many of those corner suites come out. So maybe do the homework to find out who else is listed in your building, in your area, that's comparable to you. Do you have a 500 square foot terrace? That could appeal to many people because there's not a lot of those too. So,
yeah.
All right, thank you. I hope that helps Green Horizons. Let's take in a question. Actually, this is a question coming in from Frank. Is it prudent to underlist a property worth 1.7 million in Maple? So I think this goes back to Davin and Gus rotations for your listings and the different strategies you chose.
Do we lose John?
you just cut out there, Urmi, the last 10 seconds, there was no volume. Sorry.
Apologies. Yeah, I think my signal might be a little. Can you hear me now?
Yeah.
Yep.
Okay. I'll just re-ask here. So a question comes in from Frank. Is it prudent to underlist a property worth 1.7 million in Maple? And, again, Davin, are you the last man standing here? We're having some tech issues. It's mostly land value, Frank is saying, but I think this points probably back to what you were saying, that each market is so different.
Not for land value.
Yeah, probably not land value, because there's not a lot of developers.
The price to build is too high. The red tape to go through to do so is too high. The buyer pool is going to be so low. No, you're going to list low. You're going to fail on offer night, and then you're going to have a stigmatized listing that just didn't sell on its offer night. Yeah, you're much better off just to do a proper valuation. Don't get your head in the clouds, and list it that way.
Yeah, I tend to agree, and I'm on. I shut my video because I think I'm the one who's streaming is having issues. But yeah, I do agree. It's not so much the price point. I mean, I've seen listings in the 3-4 million range with offer nights that are successful. It has more to do with the property, and if it's just land value, those are definitely tougher to sell and move in this market.
Look at that picture of John. What a coif. That's lovely.
All right.
Where does he get the coif? No, that's not the next question. The next question is from ZG. The government is tightening immigration. Will this change the long-term trend of the housing market?
Tightening what regulation?
I believe this is about the temporary numbers.
Oh, immigration.
Yes.
Sorry.
Yes.
Yeah, I mean that shouldn't. Let me pick off my video again. Hopefully this works. That should, in theory, take some pressure off of rent growth and price growth. Again, we'll have to see if the government actually goes ahead with this. If they do, for those people who aren't familiar, that would basically take our population growth from 1.2 million people per year-ish, which is what we're at now, to 300,000, which of course is going to have a huge impact. We don't know how that's going to play out, but in theory, if they do that, that should take some pressure off of prices.
Okay, thanks, John. And our final question, I thought this was a great one from Kite Technology. How do city priorities like gentrification, adding transit, affect home prices when the advantages won't be realized until months or years from now? For example, the Finch LRT, the Eglinton LRT, and the Ontario line. Come on, isn't Eglinton opening? What do you mean, months from now? But a good question, what does that really mean, actually, and for those neighborhoods?
I mean, my experience is like they don't have this immediate effect on prices. If you look at some of the areas around the Eglinton LRT, it's not like prices have skyrocketed there because it's expected to open up. I think personally, maybe people get more motivated to buy in some of these areas, but we're probably not going to see the effect of that until they're actually open, as people start gravitating closer to transit. But it's not like this massive difference, I would say, that people think it is. It's not like, prices, appreciate at double the rate just because you're close to transit. And you see that even in along the Bloor subway line. I mean, if you're walking distance to Bloor, yeah, I mean, you're a little bit, more valuable, but it's not like it's this massive difference.
Yeah, I recall seeing listings in 2016 saying, close to the upcoming Eglinton LRT. That was obviously 8 years ago. So I'm not sure how many people got really excited for that. But on the other side of the coin, if you're living on Pape, near Pape, on Muriel, on the new Ontario line, it's going to go the other direction. When they're digging a tunnel underneath your house for that little stretch. So those are considerations to make as well.
Yeah, absolutely. Awesome, guys. Well, thank you so much for joining this month and for talking about some of the trends you're seeing and for helping with some of our questions.
Thanks for having us.
Yeah, thank you.
Right.
See you later.
So we'll bring on David Larock, mortgage broker extraordinaire, regular contributor to Move Smartly, sharing his weekly insights on the mortgage market. David, thank you so much again for joining us.
Thanks for having me.
Hopefully my internet stream survives. It's a little bit flaky, it looks like, but hopefully it keeps going. So maybe if you can kind of unpack for us some of the latest things you've seen in the market. I mean, I was kind of reading your latest blog post, but maybe you can kind of unpack some of the key issues that you touched on your latest update on the mortgage market.
Sure. Well, it was an exciting week last week. The Bank of Canada finally cut its policy rate, first time in more than 4 years. The last time the BOC cut was in March of 2020. And back then they cut 3 times by 0.5% each time. That's, if you remember, when COVID was just unfolding and the bank thought we were going to have a repeat of the Great Depression. So it's been a long time. Rates have obviously gone a lot higher since then. And last week, the Bank of Canada finally was satisfied that it could begin to reduce the level of tightening that its policy rate is exerting on the over the economy. The question, of course, it's funny. All the press was peppering Governor Macklem about how many more cuts and how low are you going to go. And at one point, he sighed. As a parent, I could relate. He sighed and he said, "Let's just enjoy the moment."
That's actually so great.
Like, can we just for 1 minute enjoy the fact you finally got your rate cut? But of course, we're not happy. We want to know what's next. The reality is, John, inflation has now cooled sufficiently. The bank said it would cut when it felt like we were on a clear path back to 2%. It said it wouldn't wait till we got there because, of course, it sets monetary policy with the goal of skating where the puck is going. Right now, while inflation has continued to fall, overall inflation is down to 2.7% in April, or was down to 2.7% year over year in April. That's down from 3.4% last December. If you back out mortgage interest costs, which most central banks don't even count, inflation has been at 2% now for the past several months. And if you back out all shelter costs, and again, you could argue whether we should do that or not, but ex-shelter, CPI is now down to 1.6. We're actually below target. Mm-hmm. And by the way, the reason why you would argue in favor of backing out shelter costs is because shelter costs are driven primarily by 2 main factors. One is mortgage rates, which are directly affected by the BOC's rate moves. And the other thing affecting shelter costs right now is record levels of immigration. And that is a structural that is an impact that is considered structural, not cyclical. In other words, it's happening regardless of what the BOC sets its policy rate at. People need roofs over their head. So it's not like keeping the policy rate higher will exacerbate the supply-demand imbalance that's been caused by record levels of immigration. So with that in mind, the bank is satisfied inflation is cooling and also concerned about the level of slowing in the economy. We've had GDP revisions. We just avoided a recession last year, Q3 and Q4. Q3 was negative. Q4 was revised down to 0.1 quarterly growth. The GDP numbers just released last week showed that GDP grew by less than expected. The BOC was expecting to see quarter-over-quarter GDP growth of 2.8%. That was its forecast in its latest monetary policy report. The actual number was 1.7. That's a big miss on the downside. Employment is still hot. We had the 90,000 print last month. But as I keep pointing out in my blog posts, we need to create 60,000 new jobs each month just to keep the population, employment rate steady because of all the immigration we've seen. And the average over the past 12 months has been 31,000 new jobs. So we are creating more slack in our employment market over that 12-month period. And yes, we saw the 90,000 jobs in April. May just came out and the employment was I think 30,000, but most of the new jobs were part-time. We actually lost full-time jobs. So there is weakness emerging in the employment market. Productivity is obviously still a big concern for the bank. But the reality is the economy is slowing now, and rates are too high. The government has to, the Bank of Canada has to remove some restriction. We're still, the Bank of Canada's policy rate is still quite tight. It's average. The Bank of Canada's average policy rate is about 0.5% above the rate of inflation. So that suggests that in a more balanced environment, it would be somewhere around 3.5% right now, and we're still at 4.75. So I think the Bank of Canada is going to keep cutting. I think it has to. A lot of talk about mortgage renewers. The fact that the half of Canadians who haven't renewed their rates yet will be renewing, increasing number of them will be renewing rates that they got during the pandemic that were 2% or lower. Thus far, renewal rates, people have been coming out of rates around 3 and 3.5% and going up to rates of about 5. If you're renewing a rate of 2 to below 2%, the payment shock of the mortgage renewer still coming down the pipe is going to be increased, because the rates they'll be renewing out of were pandemic rates that were super low, or an increasing percentage of them will be renewing pandemic rates, especially borrowers with fixed payment variable rate mortgages. Most of them have already adjusted their payments, but there'll be a bigger adjustment at renewal. And with that in mind, the BOC, if it's skating where the puck is going, had better start cutting and cutting fast. And I'm in the camp that believes the Canadian economy is going to slow by more than expected. I think we're going to see more rate cuts than the market is currently pricing in. Market thinks we'll get another 0.5 point. I think the BOC is going to start cutting by a lot, and I wouldn't be surprised if we were 1.5% lower in a year's time. I think, again, always a little bit nervous when trying to predict timing, but there's a lot of tightening. At its current level, the BOC's policy rate is still exerting a lot of tightening impact on the economy. The economy is slowing more than expected, and the BOC's got to be in a hurry to take its foot off the brake pedal right now.
Interesting. Now, so, and I've heard this from a few people. I think Ben Rabideau we had on was also in the camp that he thinks the bank's going to be cutting a lot more than the market's expecting, for the same reason that he felt that the economy's not doing as well and is going to slow down quite significantly. Now, one thing you kind of touched on in your post, which I thought was interesting, was this idea about how much can the bank cut if the Federal Reserve is not cutting. And, maybe unpack that a little bit, this idea that, one of the concerns we hear about is that if Canada cuts way more than the Fed, this will put, downward pressure on the dollar, which will drive up prices of imports, just kind of import inflation. So maybe unpack some of those ideas, what that tension is, and why you think, or you mentioned in your post, that you think the Bank of Canada can, in fact, cut more than the Fed, or allow those policy rates to diverge a little bit more than people are thinking.
Sure. Well, right now our economy is on very different trajectories. The U.S. government, federal government, is spending money like drunken sailors. They're spending as if they were in the middle of a severe recession. They're not. They're in a nice long expansion. So fiscal policy in the U.S. is really stimulating growth. The savings rate in the U.S. is much lower. They burnt through a ton of their pandemic savings. Canadians have saved more cautiously the pandemic savings that they built up. So in the U.S., a little bit more living for the moment, which is driving the economic numbers and helping there. Also in the U.S., lots of 30-year fixed rate mortgages. We have very different mortgage markets. In Canada, Canadians feel the hit from higher rates more quickly, but our market also resets at those rates more quickly. In the U.S., a lot of their regional real estate markets are frozen up right now because and the mortgages aren't portable. So if you're sitting in a house with a 30-year fixed rate at 2.5%, and right now the new rates are up in the 5.5–6% range. They're higher in the US. When you have longer fixed rate mortgage terms, the rates that come with those are higher because the lender is committing to a rate for a longer term. So there's an additional premium for that. And if you're a borrower sitting in a house at 2.5% and you want to upgrade, you want to move up to a larger house, not only do you have to pay the higher price of the house, but you have to reset your mortgage rate voluntarily from a nice low pandemic rate of say 2.5% up to something around 6%. And as a result, that has really locked up the real estate market. So long story short, John, the Canadian economy is feeling the brunt now. Canadians have been more cautious, so our economy has not benefited as much from a drawdown in pandemic savings. That'll be good for our economy in the long term. That's a healthy thing, but it means that our economy is slowing more now. A lot of our data has been propped up by record lows of immigration. You and I and guys like Ben have been talking about this for a long time. On a per capita basis, our economy is really slowing. So if you're the BOC and the Fed, it makes sense that you should have different monetary policies. I think, by the way, the Fed is going to start cutting. I just think it's going to take a little bit longer. I don't think the U.S.'s economy is as strong as their numbers suggest. But the reality is right now, the BOC has started cutting and the Fed hasn't cut. Back in the mid-90s, the BOC's policy rate got 2% below the U.S. Fed funds rate. And back then, the Canadian dollar was worth $1.40 US. Right now, the Canadian dollar is worth $1.38 US. So I would argue the currency markets have already priced in more divergence between the BOC's policy rate and the Fed's funds rate than we currently see. And that is often the case. The currency markets will be forward-looking. When that happens, it makes our exports more competitive because foreigners buying our products in Canadian dollars are now paying a lower relative price because the loonie has cheapened. Also, and this is true of the US market, by the way, the Canadian dollar hasn't fallen by much. In fact, it's appreciated a little against lots of other currencies, but we really trade with the US primarily. So it's the impact between the devaluation of the loonie versus the greenback that has the real impact on our economy. The other thing, our exports become more competitive. So that's good for our economy, good for growth. But it also means everything we import in from the US becomes more expensive, and that's inflationary. That raises prices. So the concern is that if the loonie really weakens against the greenback, that we will see another inflation uptick tied to imports being expensive. And if that happens, we're going to see some additional upward pressure on inflation. But I think there are too many factors causing deflation that ultimately it won't balance out. And ultimately, John, the BOC feels that it has lots of room to go farther if it needs to. The currency markets are already pricing in a wider divergence. If we were at $1.40 versus the greenback back in the 90s, lots of other factors, by the way, affecting things. But if a 2% divergence got us 140 against the greenback back in the mid 90s, we're about 75 basis points apart right now. And we're at $1.38. So I don't think, I think most of that's in the price right now. And the BOC is right to say it can diverge for a time. If it's a year from now, John, the longer that divergence continues, the more significant it will become. But for now, I don't think it's a problem.
That's helpful. David, we're going to turn it over to Urmi, see if we have any kind of questions from the discussion to go over as we balance our technical issues here with our feed.
Hi, Dave. Yeah, a few gremlins today. Okay, I think we have enough time for one question. For those who didn't have their questions answered, again, John and Dave's contact information are in the show notes. Dave, this is a little bit, I guess, mortgage adjacent, but I suspect many are wondering things like this. So Nikki asked us a question in advance of today's session. Thank you, Nikki. She came onto our live chat in advance. Hello, I have a question about my home equity line of credit. I don't know if it's better to close to 3 years term with the 5.23% interest rate, or leave it like revolving as it is right now. Thanks. So not sure, Dave, if this is quite in your wheelhouse, but I'm sure many people are thinking about things like this.
Sure. Well, this is really a fixed versus variable question. So the question is, do you pay a line of credit rate, which is probably prime plus a half, which today is 6.5, or sorry, 5.9. Prime plus a half is 7.45%. Or do you convert? And if you convert, you can convert to a fixed rate, and a three, something around 5.29 is a decent 3-year fixed rate. Or you can convert to a variable rate. If you take a 5-year variable, you can probably get close to prime -1 or prime -3/4. In that case, you're also saving money in the line of credit rate, and you still participate and win if the BOC continues to cut rates. Should you do it? You know, Urmi, it's really hard to have a one-size-fits-all answer for this one, because it really does depend on the borrower. How much do they owe on the line of credit? You know, how much can they afford to carry the line of credit payment versus the mortgage payment? Because the line of credit payment is interest only. Even though the rate's higher, the payment's actually lower, because you're only paying the interest as the minimum payment. So even if you convert to a 3-year fixed rate, the rate goes down, but in many cases the payment increases, because now you're amortizing. You're paying off debt with each payment, which, by the way, is what you want to do. But from a cash management standpoint, if this is a short-term issue the person's having, again, there are some factors to consider. The reality is it doesn't make sense to carry debt on a line of credit long-term. If you think you can pay it off in the next 3 to 6 months, it's better to have the flexibility, because lines of credit are fully open. You can pay the whole amount at any time. But if you're going to carry the debt longer term, I think it does make sense to convert it to either a fixed or variable rate. Number one. So short answer to the first question, yes, you should look at converting if you're going to pay that debt off over time. Whether you should convert to fixed or variable, well, that's a tough call. You gotta read my blog, you gotta read everything John writes, and you gotta make a call, because you know, we all have opinions on this, but each borrower has to live with the consequences of their decision. And ultimately, you know, I think variable is going to save money. I've said that in my blog post, but that is an opinion, and should be treated as such.
I like it. You're ending on a plug for the Move Smartly blog. You can find all of Dave's latest opinions and assessments there, and also John's latest report on the market with all the data that he was sharing earlier. So thanks, Dave and John. And for all of you that have more questions, as I said, contact information is in the show notes today.
Awesome. Thanks everyone for joining us, and we'll be back next week. I'm going to be out of town, so we'll see if our live stream's going to work well. We might have to cancel it. We'll see, but we'll see how next month
No,
goes.
be hopeful. We survived today.
Let's go. Beautiful. All right. See everyone.
Thanks for joining, everyone.
Thank you.